Well, last hour, President Trump was speaking at a bilateral meeting with the Prime Minister of Romania, where he did address the U.S. economy and Federal Reserve rate cuts. Listen.
I think the word recession is a word that's inappropriate because it's just a word that the certain people, I'm going to be kind, certain people in the media are trying to build up because they'd love to see a recession. We're very far from a recession. In fact, if the Fed would do its job, I think would have a tremendous spurt of growth. The Fed should be cutting, and I would say they should say at a minimum 100 basis points over a period of time, not at one time, but over a period of time.
Can I just say one thing in defense of the media? The reason we're talking about recession, the R word, is not because of political motivations. It's because the yield curve inverted. 7 out of the last recessions, you saw a precursor in the inverted yield curve. You're talking to CEOs that are worried about recession. We don't want a recession. This is what people are talking. This is what investors are worried about.
Recessions suck. They're the worst. People lose jobs. And they're actually really the worst for those who don't have the money. It's actually not the CEO that I'm worried about. It's the person who can't pay their medical bills, can't afford to pay that tuition check. That's what we're, and that's what the government policy is meant to help ensure we have the right safety net for when that does happen.
Kristen, obviously, what's interesting is whether we're headed for a recession or not, the final phase, if it lasts a year, if it lasts 6 months, if it lasts 2 years, you always have this question. When might the recession hit? What is already priced in the market?
When is the cycle over?
Exactly.
And here's the thing, is it's actually impossible to time. But one of the things that we look at is, so at Citi, we maintain a bear market checklist where we look at 18 different criteria. And it's the criteria that you would imagine, the yield curve being one of them, but also looking at sentiment, looking at leverage on corporate balance sheets, looking at valuation. And out of those 18 factors, only 4 are flashing red right now. And to put that into context, in 2000, it was 17.5 out of 18. And then in 2007, it was 13 out of 18. So what that's telling us is not the immediate direction of markets, it's whether we should buy the dips. And we are confidently buying the dips when we see these pullbacks.
I mean, the other confusing thing out of this, Phil, is that even if we are going to recession, there's no telling what the timing is, and there's no telling what the stock market's going to do, because after the yield curve inverts, often the stock market can go up for several months.
Yeah, it's the age-old question for us that we're trying to figure out. What is the bond market at 1.5% on a 10-year note telling us? And if it's, the veracity of the move lower has caused us to pull back a little on equities, to be clear, here in August. However, if you really want to say that it's something sinister, you have to believe 3 things. 1, the Fed is not going to be effective in this mid-cycle adjustment and keeping financial conditions easy. 2, you have to believe that there actually is political will for a trade war. That is not clear. We've seen postponement after postponement on the trade deal. But number 3, this is the biggest thing, you got to take the other side of the U.S. consumer. The U.S. consumer, and you guys have talked about it a lot over the past couple of days, has been nothing but resilient in June and then again in July. And you put all those things together, every president in history has wanted lower rates. President Trump is just saying it, right? And if he's calling for 100, we got 25. We're going to get another one. We're probably going to get 75 in total. We're almost there. So if he would just stop saying it, maybe it would be easier for the Fed to actually do it.